Imagine waking up tomorrow to find that cash still exists, your bank balance still shows a number, your paycheck still arrives on time, and yet nothing works. Your card is declined, fuel stations close, supermarkets stop restocking, flights are canceled, not because money disappeared, because credit did. That's the first truth we need to face. The modern world does not run on cash, it runs on promises, and those promises are called credit. Most people never see it because the system is designed to feel solid, quiet, normal, invisible, but underneath daily life is a machine that only works as long as everyone agrees the future will be bigger than the present. Right now, that assumption is being tested. This matters today because nearly every major economy on Earth is carrying more debt than it can ever realistically repay. Governments, corporations, households. The question is no longer whether the system relies on credit, it's whether that reliance has gone too far to reverse without damage. To understand how we got here, you have to unlearn something simple. We're taught that money comes first. You earn it, you save it, you spend it. That story is comforting. It's also wrong. In modern economies, credit comes first. Money shows up later. When a bank gives someone a loan, it doesn't hand over existing cash from a vault. It creates new money digitally. The loan itself becomes money. That new money gets spent. That spending becomes someone else's income. And suddenly, the economy looks bigger. Nothing physical changed, only numbers and trust. This is not an accident. It's the core design of modern banking. For most of history, economies were limited by physical money. Gold had to be mined, coins had to be minted. Growth was slow, constrained, and brutally real. Then banks discovered something dangerous. They realized they didn't need all depositors to ask for their money at the same time. So they started lending against deposits, then lending more, then lending far more. This became fractional reserve banking, and it transformed money from an object into an agreement. From that point on, growth no longer depended on production alone, it depended on confidence. Fast forward to today, over 90% of all money in circulation exists because someone somewhere is in debt. Mortgages, business loans, government bonds, credit cards, student loans. No borrowing means no new money. This is where the system quietly reveals itself. Look at housing prices. They don't rise because houses suddenly became better. They rise because buyers can borrow more. Lower interest rates don't make homes cheaper. They make loans larger. Prices follow credit, not wages. The same logic applies everywhere. Corporations expand by borrowing against future earnings. Governments operate by borrowing against future taxpayers. Entire nations survive by rolling old debt into new debt. The system assumes tomorrow will cover today, and most of the time, it does, until it doesn't. Recessions don't begin when people stop working. They begin when lenders stop lending, when banks hesitate, when trust tightens, when risk becomes visible again. The 2008 financial crisis wasn't caused by bad houses, it was caused by frozen credit. Banks stopped trusting each other overnight, lending collapsed, and suddenly the global economy realized how thin the floor really was. Central banks stepped in, not to fix the system, but to keep it breathing. Interest rates were slashed, trillions were injected, asset prices were supported, the message was clear, credit must keep flowing. And it worked, not because the problem disappeared, but because it was delayed. Here's the uncomfortable math. Debt grows exponentially, economies grow slowly. Global debt is now more than 3 times global economic output. That imbalance only works if borrowing stays cheap forever. But interest rates don't obey wishes. When rates rise, debt becomes heavy. When debt becomes heavy, growth slows. When growth slows, credit looks risky, and risky credit stops expanding. That's the danger zone. Publicly, the story is progress, digital payments, cashless societies, seamless finance. But underneath, the system is becoming more centralized, more fragile, and more dependent on constant expansion. Cash feels old-fashioned. Credit feels modern. But cash is final. Credit is conditional. Your card doesn't represent money. It represents permission. And permission can be revoked instantly by institutions you don't see and systems you don't control. This is power. Quiet power. Long-term, the risk isn't collapse tomorrow. It's stagnation under pressure. Aging populations, slower growth, political tension, financial repression. Credit systems need growth the way engines need fuel. Without it, they stall. And when systems stall, someone pays the price. This is why inflation is tolerated, why debt is rolled forward, why structural reform is endlessly delayed, because shrinking the system would mean confronting limits we've spent centuries avoiding. So when people say money makes the world go round, understand what they really mean. Credit does. Cash is just the illusion that makes it feel real. And the most important question facing the modern world isn't whether this system is fair, moral, or efficient. It's whether a civilization built on borrowed futures can survive the moment the future stops growing. Because when belief wavers, even briefly, the promises holding everything together are tested. And that test never arrives gently.